So we are almost near the halfway mark of 2024. And I think it's an opportune moment for us to review, to relook, to recalibrate our understanding around many of these popular and famous Chinese technology companies that might be on your watch list or even in your portfolio today. So if you just take a general look at the Hong Kong market today, most investors will look towards the benchmark index, which is the Hang Seng Index. So when looking at the Hang Seng on a year-to-date basis, they delivered around a 9.4% returns. And that still trails behind their US counterparts, whether looking at the S&P 500 or even the Nasdaq QQQ, which delivered closer to 12 and 13%. Not forgetting that the Hang Seng or the Hong Kong market has came out of its 3-year bear market cycle and it's still technically in a bull market from its January 2024 lows. However, when we look at the component of the Hang Seng Index, it's not necessarily the focus of this video. Sure, there are tech companies like Tencent, Alibaba or Meituan, but in the Hang Seng Index specifically, they include many of these traditional finance players like HSBC, one of the largest Hong Kong banks, AIA, one of the largest insurer, and CCB, which is one of the largest Chinese banks out there. So, the natural question would then be, how did Chinese tech perform as a component or as a basket of goods or stocks in this case? So if you were to benchmark the Hang Seng against two of these popular Chinese tech ETF that I know of, which is KWEB, KraneShares answer to this Chinese tech demand, and iShares Hang Seng Tech Index. It's a mixed bag results. And the bigger question, of course, is whether this recent pullback provides you an opportunity to continue entering into your position, or whether is this just another fake rally that we have seen over the last 2 to 3 years. Now, when we look at the specific components of the tech index, KWEB basically wrap around the popular names and weigh them according to, I presume, the market cap, which is why you can see that Tencent, Baba, Meituan, Pinduoduo, they make up a majority of the index, and just this 4 position alone makes up around 35%. On the other hand, when we look at iShares Hang Seng Tech, sure, we have the popular names like Meituan, Tencent, Alibaba as well, but the weightage, firstly, is different, and secondly, it's not necessarily how the market acknowledges based on popularity, clearly, because Alibaba is ranked like number 6. But that aside, because of how they weigh the different tech companies, which kind of resulted in the difference in returns, some of these interesting companies that are included in the top 10, like Lenovo and Haier, which is not necessarily the names that people recall at top of mind when you talk about Chinese tech companies. Hey investors, now you can get up to 7% in money bull interest for up to 180 days with returns of up to $3,500. So Moneybull is open to all Webull accounts from June onwards for you to access easily. Previously, it was only applicable to margin accounts. Additionally, for those of you who would like to trade, deposit minimum $2,000 and complete 3 US buy trades and maintain until the 31st of July 2024 to get $80 worth of cash vouchers. On a much higher tier, deposit minimally $10,000, complete 5 US buy trades, and maintain it until the 31st of July 2024 to get $400 worth of cash vouchers. So if you're looking to invest in the US market, consider switching over to Webull. So known for its low trading fees, intuitive interface, and powerful tools, Webull could be your ideal trading platform. Additionally, Webull's latest Transfer In promo provides attractive rewards for both new and existing users who haven't transferred shares to Webull before. You can select a right tier to initiate your share transfer and fulfill the maintenance requirement to get up to $1,500 worth of trading vouchers, plus up to $150 worth of transfer out fee subsidy upon successful transfer in. So sign up now with the link below and grab your rewards today. So I took the liberty to name out the top 10 Chinese tech companies and rank them by market capitalization. I did take out a few other characteristics that you guys might be interested in. So if you just look at them, if you rank them based on market cap, yes, Pinduoduo has recently surpassed Alibaba in market cap again, making them the number 2 tech company. So just going down the list, you have Tencent, Pinduoduo, Alibaba, Meituan, NetEase, Xiaomi, JD, Trip.com, Baidu, and Kuaishou. And I was just curious in terms of which tech company had the biggest drawdown. And it seems like the top two winner is Kuaishou and Pinduoduo, which with a close to 90% drawdown. On the flip side, I also wanted to know which company has already multi-bagged from the bottom. And to no one's surprise, Pinduoduo, which is one of the largest growth recovery story and a great expansion story in the US today with Temu, had already achieved a 5x if you compare its bottom share price to where it's trading at today. And another interesting fact, especially for those of you who buy into the mean reversion theory, especially reverting back to its peak, Kuaishou would be top on the list because at its current share price, it's still trading close to its bottom valuations and it's still very far from its peak, close to a 7-bagger. And for other popular names, Alibaba still can 3x to reach its peak valuation, and Tencent still can 2x from its peak valuation. That said, I think the discussion here should be a lot more nuanced. Some of these companies have experienced a great amount of competition. Their company's moat might not be as strong as ever. The expectations being baked into the stock price 2-3 years ago might not come into fruition, which is why you see such a huge amount of sell down. And I guess the future is anyone's guess. And I just wanted to insert a quick plug for my newsletter. So in this video specifically, I'm just going to focus more on the qualitative aspect of the business. But as we all know, in investing, the qualitative analysis is only one part of the equation. You have to take into account the risk factors, the valuations of it today. And specifically, for those of you who want to know my own personal ranking of this top 10 Chinese tech companies as an investment opportunity today, feel free to join the newsletter in the link down below. And I will basically share my top 10 ranking sometime next weekend. I'm intending to kickstart and to revive it again. And I'll send out a newsletter every second and fourth weekend, whether is it a Saturday or Sunday, depending on the time. So I think that's just generally it. If you're interested, the link is down below. Pivoting over to the first contender of this list, which is Tencent Holdings. I think Tencent really needs not much introduction. So what you're basically buying is China's largest super app, and WeChat is basically the heart of the entire machinery and the operations of Tencent. They basically own the entire media and communication framework system fundamentals of China today. Buying into Tencent, you are basically buying into the heart of China's messaging. So some might ask, is Tencent in the business of gaming, in the business of social media, in the business of advertising, etc., etc.? Truth be told, in my perspective, I think Tencent is in the business of data flow. So this data that they get and they harvest from the billions of people on their network, the 1+ billion people in China today probably has WeChat installed onto their mobile app. I'll be quite impressed and quite surprised if you go to China today and you ask anyone that you see on the streets, if they don't have WeChat installed, I think they're probably living in a cave. But that's besides the point. I think the idea of in the business of data flow means that Tencent has first-hand knowledge and first-hand access to many of these developments in real time, which can be used to funnel to other parts of their business, like game development, like investing into other businesses, and to know what are the needs and gaps in people's day-to-day life. And it's basically a positive reinforcement loop, which also enabled them to build an investment portfolio, which is some sort like a mini Berkshire. So they are the king of social media, they have the biggest reach, most extensive network, they are the king of digital payment, they're the king of gaming, they're king of capital allocation. And that basically provides you the framework of understanding Tencent's business model today. In terms of the mode, Tencent is a 10 out of 10. They have the scale, they have the network effect, they have a huge amount of switching costs. But on the other side of the story, this is also something that you want to know. So due to its size and importance today, they are probably joined by the hip with the government, which is the infamous government that most investors are afraid of. You can say that they are subject to media control, they have to censor certain posts, they want to control the narrative, there's regulatory actions, there's competition control, they don't want them to be anti-competitive, there are gaming oversight, etc., etc. I would presume that they have a cordial relationship, but from time to time, you're going to see some headline news that the Chinese government is implementing XYZ, relooking into some parts of Tencent's business model because of some political reasons, etc. And on a second note, Tencent's core offer, which is WeChat, They probably would find it challenging to expand globally, which is its super app that they offer basically everything under the sun, which works flawlessly in China due to the integrated system and basically the relationship with the different partners, but has very big issues trying to expand global seas. And specifically for Tencent, they can continuously expand their network overseas via their gaming division and even their investment vehicle. But the Chinese story is still critically important for Tencent's growth, and they need to continue flourishing in order for Tencent to harvest more per user. So if you do believe and you do buy into this thesis, then sure, I think Tencent is a pretty good bet. Now, moving on to the second contender, which is Pinduoduo. What you're essentially buying if you buy Pinduoduo today, so it's a Chinese behemoth that disrupted many of the incumbents by integrating social element into a very old enterprise, which is called e-commerce. So they're fiercely competitive, even in the process of taking market share in the Western countries with their Temu arm. And they're growing at astronomical rates, never seen before, even rivaling that of Nvidia. They're growing at triple-digit growth at its current pace, yet they're scaling extremely profitably, which I still can't really understand today. So it's a phenomenal growth story at its prime today, which is why it's kind of baked into their valuation. And their mode is essentially just cost advantage and scale efficiency. If you go onto Pinduoduo's app, whether is it the Chinese version or the US version, they're basically selling items at never seen before prices. Personally, I might be biased. Full disclosure, I have a full position in Tencent and Alibaba. But until today, I still cannot figure out how Pinduoduo managed to scale so quickly, yet so profitably, especially in the West, where many other Chinese players have tried to penetrate but failed to do so. So Pinduoduo will probably go down in history in one of the most successful businesses that managed to penetrate into the West and scale so effectively, or there might be something fishy going on. So the disclosures in their earnings are not very well dissected, so I'll refrain from commenting too much. But I think something that you might want to take note of when you want to compare a player like Pinduoduo versus Baba and JD is that the mindset and quality of consumption of the consumers on these three different platforms are pretty different. So the order quantum on Pinduoduo is much smaller because they go by scale and go by speed, and the return rate, because of some level of impulse buying, is also a lot higher when you compare it to Baba and JD. So that's just naturally the difference in business model. And I think the same can be said if you want to look at other e-commerce players like ByteDance and Douyin. So the third on the list is of course the fan favorite Alibaba. What you're basically buying is the former number two. Alibaba until today still has the most extensive reach and network in the entire world's commerce infrastructure. So they're moving twice the size in GMV, which is gross merchandise value, when you compare it to even the largest US counterpart, which is Amazon. So the iron triangle mode is still healthy, but some might argue it's declining. And what is this iron triangle? Which is the variety of products that they offer on the e-commerce platform, optimized and efficient delivery network, and the most important pie, which is a trusted payment ecosystem. And this whole self-reinforcement cycle and mode that Alibaba has created was also one of the reasons why Ant Financial was so successful in the first place, which basically locked everyone into the payments and e-commerce system. So Alibaba is also currently working on their international e-commerce expansion. They're trying to concretize their network. They've lost the lead to many of these region partners. But they are basically resuming back to growth, and they're also trying to position themselves to lead this AI and cloud race with not much to show yet, particularly so when their e-commerce business is already so huge. These incremental triple-digit growth rates, they're still extremely nascent and they're not very accretive to the entire business for now. So that's why I say yet. So what you should know is that growth has been faltering, management has been distracted, the transition has been messy, execution has been lackluster over the last 3 years. So their up-and-coming rival, which is Pinduoduo and Douyin, has cleverly replicated their scale via extremely innovative means, such as social commerce and also live streaming and social media. So once upon a time, when Alibaba was extremely proud about its scale and its network, it used to be a huge moat for Alibaba, but some of these competitors have already managed to replicate the scale, not using traditional means, but rather using other means. And some might argue that regulators are still breathing down their neck, but we'll see. Now, fourth on this list is Meituan. So what you're basically buying is China's largest anything delivery system. And if I may argue, it's the third application in most Chinese smartphones today. So Tencent, WeChat is the first, Meituan is the third. So if you haven't guessed it, the second app is probably Taobao, which is owned by Alibaba. So Meituan really started out with food delivery, basically addressing the gap, very much like Uber, like Grab and stuff like that. So they started off with food delivery, and then they started pivoting and offering different offers and services like Insta shopping, hotel and travel. And their business model is simply by taking a commission and offering the digital real estate in their innate platform, and they can upsell and downsell to the pool of their existing customers. So like I said, they start off with food delivery, and now via their Insta shopping vertical, they're even delivering flowers, some postcards, etc., etc. So it kind of morphed into a much larger enterprise. So Meituan used to be an extremely high growth company. They took a hit because of the pandemic, and right now they're reverting back to growth as the China middle income boom story gains traction again. Now, what you should know is that tech as an industry is extremely cutthroat, and everyone else seems to be eyeing this delivery pie. Like seriously, everyone. From what I understand, Tencent has something like that they have to offer. Alibaba has something like that they have to offer. But Meituan, as of now, still do command a respectable level of loyalty. And they're also always at odds of balancing stakeholder benefits versus shareholder profits. So I think an example or a news that, or at least a headline that broke out 2-3 years back was that Meituan was basically squeezing some of its stakeholders, including its riders, by not providing sufficient insurance coverage in order to deliver more bottom line profits, or basically to deliver higher margins. So that's kind of, it's a very extensive and a very messy network, and they have to kind of balance out everyone's interests. Now, moving on, number 5, for NetEase, what you're basically buying is China's number 2 gaming company. Tencent is number 1, but NetEase, they basically managed to carve out a niche. They have a full portfolio of genres of different games, whether it's mobile or desktop, and they have been competing against Tencent for decades now. And they have a knack of delivering blockbuster mobile games that capture the minds of their player base. And specifically for NetEase, they have put capital and R&D to good use for the last decade, and they've delivered respectable returns in terms of their invested capital and also their equity. But that said, if you're to ask me as an outsider, what really differentiates them, what's the moat of NetEase, I'm not necessarily sure. And there is also a similar level of oversight in the gaming division of China. So if I were to really want to own, if I'm interested in owning the gaming arm or the gaming industry of China today, I would rather go with the safer bet, which is Tencent, which is much more diversified. So the 6th on the list is Xiaomi. So what you're basically buying is the third largest smartphone company behind Samsung and Apple. They're basically targeting the rising affluent with extremely affordable pricing and decent quality. Because pricing and quality, they tend to be on a trade-off and on a continuum. There's a huge addressable market, specifically in developing countries. And as far as I know, I think they're ranked number 1 or number 2 in India. And as India continues to pick up the economic development, I think that's a huge addressable market in many of these developing regions. So Xiaomi has also managed to build out its manufacturing capabilities and expansion into a portfolio of products from fridge to vacuum cleaner to even smart TVs. So at least from anecdotal experience, for people around me that use Xiaomi products, they kind of like the quality and they don't really cost a lot. Now, when you look at Xiaomi, at least over the last 5 to 10 years, they're always constantly pushing towards IoT, which is Internet of Things, and AI integration into many of their products. They even go towards electric vehicle unveiling. So the Xiaomi SU7 is being produced every 76 seconds, and they target to deliver 100,000 units in 2024. And they basically just started in March of 2024. So that's basically the cadence and the speed that Xiaomi is producing and flexing their manufacturing capabilities. Growth is also kind of turning around the corner. They were still delivering some sort of a negative revenue year on year in Q2 of 2023. And over the last 3 quarters at least, they are turning into growth again. So what you should know, Xiaomi is never a premium brand to begin with. Their core strategy kind of similar to Pinduoduo, but Pinduoduo is a much lower of the value chain. Xiaomi is kind of at the mid value. Their core strategy is called 薄利多销, basically focusing on numbers and scale. They want to sell a lot and they basically get their margins from selling a lot because of the scale. So they're penetrated into multiple highly competitive environments, whether it's smartphones, gadgets, electric vehicle, etc. So this is my own perspective. They're probably never going to come out on top by serving the middle class, especially when you look at many of these companies that made it on top with huge valuations. They tend to command a premium. They have a pricing premium. They have a brand premium. And at least for now, I don't see them rebranding themselves into that kind of premium segment. But I think they do have a joker card up their sleeves. So they've been working on this IoT and integration for a really long time. And the pivotal moment here is really whether they're able to create such an ecosystem that customers really enjoy the convenience and basically any value that they are able to extract from the entire ecosystem itself. At least for now, there's not much progress yet, but I'm just going to acknowledge the fact that there is this upside or this potential. Point number 7, JD.com. So what you're basically buying for JD is China's number 3 e-commerce player. They have one of the most sophisticated supply chain and logistics network due to its investment strategy and their outright ownership of them. So JD's focus is really on high quality, high value, and authentic products, sieving out only high spenders on their platform. Now, what you should kind of know is that JD was really unable to compete with their new rivals in the space, which kind of offered a radically different value proposition like Pinduoduo and Douyin, especially in a weak macro environment that we have seen over the last 4 years, ever since the piercing of the bubble or bursting of the bubble in the real estate. So they were unable to continuously value add to this group of high value buyers that they managed to accrue over the years, and they kind of got distracted from JD's core offer, and that's why JD is experiencing some sort of a weak growth in some of the quarterly developments the last 2 years. Now, for Trip.com, what you're basically buying is the Booking.com of China. They're basically an aggregator of online travel and hotel accommodations. They try to differentiate with different travel products, travel services, and they are riding on the tailwind of the China's consumption recovery, especially after the pandemic and lockdown. But I think similarly, this industry is particularly hard to differentiate, and every tech company out there like Baba, Tencent, Meituan, they're also giving a go at it with varying success. Now, for Baidu, what they're basically buying, I think long story short, is an idea and a promise. So, at least from my understanding, Baidu has not been executing over the last decade. They have lost significant market share in their core business, whether it's in search, in media, in advertising. They are full steam ahead trying to make their mark in the AI space, and that's basically their comeback in their Gen AI, large language models, their self-driving fleet, and their AI cloud integration. So to me, what you should kind of know is that Baidu's Hail Mary will come from its execution and rolling out of its AI capabilities to the masses. They really need to hit to that critical transition factor, and they need widespread adoption. At least for now, when I look at Baidu, it's always a work in progress, and they have been a work in progress over the last 5 to 10 years already. So that's why I'm not extremely excited or confident of how Baidu will kind of turn the corner. And last but not least, number 10 is Kuaishou. So Kuaishou is China's number 2 short-form video app, behind their biggest rival, which is Douyin. And Douyin, the parent company ByteDance, is a private company. And TikTok, we all kind of know where TikTok is heading towards. They basically change entire generations of consumption methods into short-form video. And based on consensus estimates, at least in China today, Kuaishou is still quite far behind Douyin. But at least based on Q1 of 2024, they still have a respectable 394 million daily active users, spending more than 2 hours daily on the platform itself. And what has the world come to? I don't know. So specifically how Kuaishou generates most of its revenue, it's from advertising, e-commerce, and live streaming. And I think up until today, they're still not profit making. So what you should know is that for many of these short-form video platforms, they all have kind of a slightly different appeal. So they specifically focus on e-commerce marketing, which enables their conversion rate to be much higher compared to Douyin. Because Douyin basically wants to control the entire funnel, and they don't want to collaborate or work together with some of these e-commerce platforms. And they're trying to to build out their own infrastructure. So long story short, for short form video platforms, their only advantage is to create the flywheel and to keep the audience engaged. And the worth of the platform itself is basically how much people they can keep on their platform, basically commoditizing users' attention. And it naturally goes back down to their AI algo, and would Kuaishou beat Douyin? To be honest, I don't know. Based on the talent, the competitiveness of Douyin today, if really I would want to bet on a short form video platform, I think my bet would go to Douyin. So if you guys agree, disagree, feel free to leave in the comment section down below as well. And don't forget, for those of you who want my own personal ranking, when taking into account the risk reward, the qualitative aspect, the valuations today, I will release it in my newsletter the following weekend. So do remember to join the newsletter in the link down below. So with that, I'll see you in the next video. But more importantly, I'll finally see you guys on the moon. Goodbye.